Most people think a mortgage is just a loan, but very few truly understand how borrowing really works behind the scenes. Mortgages can either build long-term wealth or trap you in decades of pressure, depending on how well you understand the system. In this video, we break down mortgages in a simple, clear way, so you know exactly what you are agreeing to and how lenders actually make money. Like and subscribe, so you never miss videos that help you make smarter financial decisions with confidence. 1. What a mortgage really is. A mortgage is a long-term agreement where a lender provides money to purchase property while using that property as security. The borrower agrees to repay the loan over many years through regular payments. These payments include both the borrowed amount and interest charged by the lender. The property legally belongs to the borrower, but the lender has a claim until the debt is fully repaid. Understanding this structure is essential because missing payments can lead to loss of the property. A mortgage is not just about buying a home, but about committing future income for stability and ownership over time. 2. Why banks offer mortgages. Banks offer mortgages because they generate predictable, long-term income. Interest payments spread over decades provide steady cash flow with relatively low risk due to property backing the loan. Lenders carefully assess borrower income, credit history, and property value to reduce default risk. Mortgages are structured so early payments mostly cover interest, which benefits the lender. This design ensures profitability even if the loan is repaid early. Understanding lender motivation helps borrowers negotiate better terms and avoid unfavorable conditions hidden within the borrowing structure. 3. Principal and interest explained. Every mortgage payment consists of two parts: principal and interest. Principal reduces the original loan balance, while interest is the cost of borrowing money. In early years, most payments go toward interest, with little reduction in principal. Over time, this balance shifts, and more money goes toward ownership. This structure means borrowers build equity slowly at first. Understanding this helps manage expectations and plan extra payments wisely. Reducing principal early can significantly lower total interest paid over the life of the mortgage. 4. Fixed versus variable rates. Mortgages usually come with fixed or variable interest rates. Fixed rates remain the same for a set period, offering payment stability and predictability. Variable rates change with market conditions, which can reduce or increase payments over time. Fixed rates provide security, while variable rates offer flexibility and potential savings. Choosing the right option depends on income, stability, risk tolerance, and market outlook. Understanding how rates work prevents future payment shock and helps borrowers choose mortgages aligned with long-term financial comfort. 5. Loan term length matters. Mortgage terms often range from 15 to 30 years or more. Longer terms lower monthly payments but increase total interest paid. Shorter terms raise monthly payments but reduce interest costs significantly. The loan term affects cash flow, flexibility, and long-term wealth building. Choosing the right term depends on income, stability goals, and future plans. Borrowers who understand term impact can balance affordability with faster ownership and reduced borrowing costs. 6. Down payment importance. A down payment is the upfront amount paid toward the property purchase. Larger down payments reduce loan size, monthly payments, and interest costs. They also lower lender risk, which can improve loan terms. Small down payments increase borrowing costs and reduce equity at the start. Saving for a strong down payment creates financial safety and flexibility. Understanding its impact helps borrowers avoid overextending finances while entering home ownership responsibly. 7. Credit score influence. Credit history plays a major role in mortgage approval and pricing. Higher credit scores signal reliability and lower risk to lenders. This results in better interest rates and terms. Poor credit increases costs or limits approval options. Credit reflects past borrowing behavior and repayment discipline. Improving credit before applying for a mortgage can save large amounts of money over time. Understanding this relationship empowers borrowers to prepare strategically before committing. 8. Hidden costs and fees. Mortgages include costs beyond monthly payments, such as closing fees, insurance taxes, and maintenance. These expenses affect affordability and long-term budgeting. Many borrowers focus only on payment amounts and underestimate additional costs. Understanding the full financial picture prevents surprises and stress later. Smart planning includes accounting for all ownership expenses, not just loan repayment. Awareness leads to realistic budgeting and sustainable borrowing decisions. 9. Early repayment effects. Paying off a mortgage early can reduce interest costs and increase financial freedom. However, some loans include penalties for early repayment. Understanding loan terms is essential before making extra payments. Strategic additional payments toward principal can shorten loan duration significantly. Borrowers who understand repayment flexibility gain control over debt and build equity faster without unnecessary costs or restrictions. 10. Mortgages as financial tools. Mortgages are not just debt, but tools when used wisely. They allow property ownership while preserving cash for other investments. Responsible borrowing aligned with income growth can build long-term wealth. Poorly planned mortgages create financial strain and limit freedom. Understanding how mortgages work transforms borrowing from risk into opportunity. Educations and planning determine whether a mortgage supports or damages financial stability. Now that you understand how mortgages really work, you are better equipped to borrow responsibly and avoid costly mistakes. A mortgage should support your long-term goals, not control your future income. Use this knowledge to evaluate offers carefully and plan payments strategically. Like and subscribe to keep learning practical financial systems that protect your money and help you build confidence in every major financial decision you make.